When most people think about Social Security, they assume it's a tax-free benefit. After all, you've paid into the system your whole life. Why would you be taxed on that money again? But here's the reality. Up to 85% of your Social Security benefit could be added to your taxable income. And it's one of the most aggressive, stealthy tax traps that retirees face, especially those with IRAs, pensions, or brokerage accounts. In today's video, I'll explain how the tax trap works, what triggers it, and more importantly, how you can plan around it. And make sure you stay tuned until the end where I go through a case study to show how a couple with $2 million saved can plan ahead to make sure their benefits are taxed as little as possible. Before we dive in, my name is Ryan Knoll. I'm a certified financial planner and founder of NavWealth Partners, a financial planning firm that helps clients nationwide make smart money decisions. Let's jump into the video. The Social Security tax trap refers to the rapid phase-in of taxation on Social Security benefits as your other income sources increase. This happens because of a unique formula the IRS uses called provisional income. And provisional income includes a couple of things. First is half of your Social Security benefit, ordinary income that you receive from wages, required minimum distributions if you're of that age, and from your IRA distributions, dividends and interest, capital gains, and tax-free municipal bond income. So let's go over a brief example. Let's assume you have adjusted gross income of $30,000. That is from sources like your IRA and pension income. Let's also assume that you earn $2,000 in municipal bond interest. And while this interest is tax-free in your federal form, it is included in your provisional income calculation to determine Social Security taxability. Let's also assume that your Social Security benefit is $20,000. Your provisional income in this case would be $42,000, which is the total of your AGI, that non-taxable interest income, and plus half of your Social Security benefit. And it's important to know these numbers because if your provisional income crosses certain thresholds, a growing portion of your benefit could become taxable. And it can unexpectedly push you into higher tax brackets. So now we want to look at these thresholds to have an understanding of where we should aim to keep your provisional income numbers to avoid having to pay more in Social Security taxes than you have to. The provisional income thresholds have not been indexed for inflation since 1983, meaning more people get hit each year with increased Social Security taxes. So for single filers, your thresholds are as follows. If you earn under $25,000 from a provisional income standpoint, none of your benefit will be taxed. If you earn between $25,000 and $34,000 from provisional income, half of it will be taxed. And over $34,000, well, then you would be taxed at 85%. And for married filing jointly, those same numbers, a little bit higher numbers. So if you're under $32,000 as a married person from a provisional income standpoint, none of your benefits would be taxed. If you earn between $32,000 and $44,000, up to 50% would be taxed. And anything over $44,000 on your provisional income scale would be taxed at 85%. Here's what's actually wild about this. These aren't the actual tax rates. They determine how much of your Social Security is added to your taxable wage base and gets added to that income. And that income is then taxed at your normal rate. So if you're in the 24% tax bracket and 85% of your $40,000 benefit is taxable, that's an $8,160 increase in taxes just from your Social Security. And the real kicker, small increases in other income like a Roth conversion or a capital gain or just simply taking more money out during the course of the year can cause a huge increase in your tax bill and increase the trap. Applying that to our example from before, when you have $42,000 in provisional income and you're a single filer, your Social Security would be taxable at 85%. But had you been a married filer, it would only be taxable at 50%. And that's an issue in and of itself. It's not uncommon for spouses who enter retirement married to pay taxes on none or half of their benefit. And then when one spouse passes away, the other spouse not only receives a reduced benefit, they also have more of that benefit become taxable. And that's the last thing you want as you begin to explore retirement alone. So let's look at a little bit more detailed example. Then we'll go over 5 ways to help avoid this problem before we look at a case study that will show you what this looks like factored in the overall context of a much larger retirement plan. Let's talk a little bit about how people get trapped when it comes to Social Security taxation. And let's say you're retired with the following benefits. You have $40,000 in Social Security, $20,000 withdrawn from an IRA, $5,000 in capital gains, $2,000 in tax-free municipal bond income, and rental income of $10,000. Adding all of those up and making sure you're only taking half of your Social Security base, you would have provisional income of $57,000. And that pushes you well over the $44,000 threshold for married couples, meaning up to 85% of your Social Security is taxable. In other words, your taxable income spikes, even though your actual spending hasn't changed. That's a trap in action. And often it isn't so much a trap as it is people just not having a sound distribution strategy, which unfortunately pushes them into having more of their benefits taxed. And that's why as you enter retirement, it's really important to think about how you will not only take money to live on, but also where you will take money to maximize all the benefits you might have from your Social Security standpoint, to the IRAs you've accumulated, to the capital gains that you have within your taxable accounts. They all blend together and they're all going to affect this number. Now we're going to talk a little bit about the strategy to help you reduce the Social Security tax trap. And there are three primary ways to reduce this and two additional strategies that you can use as complements to those main strategies to soften the blow as well. The first is to delay claiming Social Security by waiting until age 70 or until you've converted all of your traditional IRA dollars to Roth dollars. It'll shorten the window during which your IRA withdrawals interact with your Social Security. This gives you a clear runway to do Roth conversions in your 60s while your taxable income is low without triggering this tax hike effect. Once Social Security kicks in, your conversions might be limited or done altogether, so that early window is incredibly valuable. You will receive a higher benefit, which itself can make more of that benefit taxable, but if you do a good job elsewhere in your plan, you still may be able to avoid this becoming an issue altogether. The second strategy you want to do is prioritizing Roth conversions before your required minimum distributions start. As we say, Roth conversions done before you start RMDs or claim Social Security can lower your future taxable income, which reduces your provisional income in turn. Think of this as paying taxes now at lower rates to avoid compounding tax problems in the future. The bonus, Roth withdrawals don't count toward provisional income. They don't raise your Medicare premiums, and they don't trigger more taxation on Social Security. This is the exact kind of multi-layered strategy we use for clients who want to reduce taxes not just in one given year, but over 2 or 3 decades. You also can utilize something called qualified charitable distributions. If you're over 70 and a half, you can give directly from your IRA to a qualified charity up to $108,000 a year in 2025, and that withdrawal won't count towards your income. That means you can meet your required minimum distribution requirement without increasing your provisional income. Even if you're not highly charitable, giving $5,000 or $10,000 through QCDs each year can meaningfully reduce your tax burden, protect your Social Security benefits, and help causes you care about. So if you're someone who has increasing required minimum distributions that you don't need to live on, or maybe you're finding this advice a little bit later on in life, you can reduce your provisional income through utilizing QCDs. Now that we've gone over the 3 main strategies we use, let's talk about the 2 complementary strategies. So the first one would be to watch how you're pulling income from other sources. Certain income sources can quietly push you into the trap. For example, taking capital gains during a year you claim benefits, triggering large one-time IRA withdrawals, harvesting rental income or deferred compensation. The solution isn't to avoid income, it's to plan it deliberately. That might mean spacing income across years or coordinating withdrawals with your Social Security start date. The next strategy is to use your taxable account strategically. If you save money in a brokerage account, you may be able to live off the principal and low gain withdrawals while keeping taxable income really low. These withdrawals can be structured to generate minimal capital gains, allowing your Social Security to remain tax-free, especially if you combine that with Roth income and the standard or itemized deduction, depending on which one you can take. This type of income layering is one of the most powerful retirement planning tools, and it's one that I see most people get wrong. Before we go into the case study that'll show how a $2 million couple entering retirement may be able to pay nothing on their Social Security benefit in the way of taxes, I wanted to say thank you for the support for the channel. It means a lot to have all of you tuning in and leaving likes and comments on these videos. It's even cooler that I've had an opportunity to meet some of you in person or over a virtual chat to talk a little bit more about your own situation and how we can help here at NavWealth Partners. So please, if you're new here, don't forget to throw us a like and subscribe to the channel. Or if you need a little bit more one-on-one guidance, schedule a call through the link in the description below so we can connect. Let's dive into that case study. So in our case study, we have 2 retirees, Joe and Sally, and they're both 62 years old. Between the 2 of them, they have $1 million in traditional retirement accounts, another $1 million saved in a taxable brokerage account with about $300,000 worth of embedded capital gains. We have a triple mandate as their financial planner. We want to distribute income to meet their needs. We want to minimize taxes across their portfolio, and we want to make sure their Social Security is taxed as little as possible. We are also going to assume that if they collected Social Security today at age 62, their benefits would be about $30,000. And if they wait until full retirement age at 67, they would be roughly $42,000. And if they delayed till age 70, the latest they possibly could, those benefits would be approximately $52,000. As their financial planner, the first thing I would want to understand is where Joe and Sally will take their income from. And let's assume they need $8,000 a month to live off of, or roughly $96,000 a year after tax. The first place I would look to do that is the taxable brokerage account. We know they have $1 million there and approximately $300,000 of that is gains. but they have a well-diversified portfolio. What their gains picture actually looks like is positions that show $50,000 worth of losses for the year and positions that show $350,000 worth of gains. In fact, we're going to get very granular here. They have a bond position that's worth $200,000 and their basis in that bond position is $225,000. So a $25,000 unrealized loss. And they have individual stocks that have a basis of $125,000 worth $100,000 or another $25,000 loss. And the remainder of their portfolio, or $700,000 here, is in one ETF that has a cost basis of $325,000 and gains of $375,000. I'm also going to assume that they want to keep the same 80-20 allocation at all points in time in this account. So the first thing I would do for Joe and Sally is harvest all of those losses, which frees up capital of $300,000 and realizes $50,000 worth of losses. I would also realize $50,000 worth of gains to offset that loss completely. That move would free up an additional $93,000 of capital, and they would incur no additional taxes on that because those gains would net against those losses. So I now have roughly $400,000 in capital that can be used tax-free, and I need to figure out the best way to utilize it. Well, first, I know Joe and Sally need $96,000 to live on, so I'm going to send that to them for the year. And just to simplify the example, we're going to assume they earn no additional interest on that money throughout the course of the year. You would want to factor in some interest accumulated in this calculation for yourself, but just for the example, let's simplify it. So at this point, I still have roughly $300,000 of capital left to allocate. In order to keep their allocation the same, I know I need to move $180,000 of that remaining capital into a bond position. I also want to make sure that I do not invoke the wash sale rule here and disqualify all of those losses. So let's assume that the previous position was a mutual fund, and now I'm buying an ETF so that I don't do that. And now I still have roughly $120,000 worth of capital remaining to reinvest. But before I reinvest, I'm going to hold about $40,000 of that off to the side for a bit later, which leaves them with $80,000 to now reallocate. But don't forget about that $40,000. That is going to come into play when we start talking about Roth conversions a little later on. And while the portfolio Joe and Sally has done very well, it's not very tax efficient. I would want to incorporate a strategy that utilizes automatic tax loss harvesting to slowly realize losses to offset other gains throughout the year to free up more tax-free money for them to spend over the next few years. For their spending plan, we would rinse and repeat this exercise each and every year where we're minimizing capital gains, which will allow them to do the more important thing now, which is convert more of their IRAs at lower tax brackets to Roth dollars before they take their Social Security and avoid having their benefit taxed at the highest possible rates. So let's look at their conversion strategy next. For Joe and Sally, it likely will make sense to delay Social Security until they have fully converted their traditional retirement accounts to Roth. This is because they've done a good job saving and have a sufficient portfolio to live off of. This should allow them to avoid taxation on their benefits and give them more wiggle room to convert more of their Roth dollars sooner. This will probably take them really close to age 70 before they claim, but let's work through the numbers. And we're going to make a couple of key assumptions here. We're going to assume that Joe and Sally just take the standard deduction of $30,000. They have no other income sources to simplify things. In the real world, you'd want to factor in dividends and interest earnings into these calculations. And they won't take Social Security until age 70 or until their IRAs are completely liquidated, whichever comes first. Before we dive into their conversion strategy, I want to look at what most people do, and that typically revolves around having no real strategy. They take money from their retirement accounts first to live on because that's what they're there for, right? They worked hard all these years and saved in these accounts, and this is where they're supposed to take their money from, or at least that's what their friends and their coworkers have told them. But that's where they get themselves into trouble. In fact, this is a prime opportunity for couples with $2 million in assets to have a significantly tax-reduced retirement. If Joe and Sally follow that strategy, they will pay at least six figures in taxes more than they should have to. And they will likely be taxed on their Social Security benefits, on their capital gains distributions, and at much higher rates on their IRAs once required minimum distributions start. Now let's take a look at what Joe and Sally should do. So we have Joe and Sally's income picture completely taken care of from that taxable account. Now, how should we handle their IRAs? This is when Roth conversions start to come into play. And for Joe and Sally, all we have to do now is run the calculations as to what the optimal bracket is where it makes sense to convert. And the way the conversions will work is we're going to fill up a tax bracket. So if they want to fill up the 12% tax bracket, just as an example, they can realize $96,700 worth of income in 2025. And when you factor in their $30,000 standard deductions, that means they can convert $126,700. And that's all they're doing here is they're finding the optimal bracket, adding the standard deduction, and then converting that final number to a Roth. And now we're going to circle back to that $40,000 we held aside from the taxable account reallocation. Those funds, those are going to be used to pay the taxes on the conversion because we want as much going in that Roth bucket as possible because that's where we're going to get the most bang for our buck. If there is any money left over after paying the taxes, that can either be reinvested or held to the side for the following year's tax bill or income distributions. So let's actually look at what the optimal scenario is here for Joe and Sally at different tax brackets pertaining to these conversions. We're going to go over how they would be taxed this year, but we're also understanding what is optimal for the lifetime tax picture. And sometimes that might mean paying a bit more now to save much more later on. So now what we're going to do here is we're looking at Joe and Sally Smith, and we're trying to determine what bracket they should fill up with their Roth conversions, meaning how far up along the tax spectrum they should go when it comes to converting their traditional IRA to their Roth IRA account, because we know that's going to save them some money. But let's first review all the different facts of the plan. So we know that they're both age 62. They happen to have the same birthday here, and they're both retired, and we have them both expected to live to age 90. We could change that based off of different factors for you. If you have longevity in your family and a bunch of people live to 100, we'd want to bump that up. If you have people in your family who've historically passed away at age 70, 75, we'd want to bump that down. Or if you're having some health problems, that would be another reason we'd bump that down. But for sake of this example, we're just going to run it to age 90, but this is dynamic. We would change it based off of the client. The next thing we're going to look at is the net worth here. So you'll see that they have a brokerage account with $1 million in it, and Sally's the IRA holder here, and she's $1 million inside of that IRA. And from an income standpoint, we know that if they took Social Security today, that's going to be worth $15,000. I have the system defaulting to taking it at age 70, regardless of what happens as of right now. What will happen in the different scenarios is we'll actually take Social Security once the IRA is completely liquidated. So that way we're avoiding that self-tax trap we're trying to manage for here today. But for right now, if they were to take the Social Security, it would be a $30,000 benefit combined for the both of them. That'll grow to about $52,000 by the time they're ready to retire at age, by the time they take it at age 70, if they were to delay as long as possible. So it's the exact same numbers that we went over before. And then looking at their expenses, we know that they need $96,000 a year to live off of. That's exactly what we have here. I have some tax assumptions in here, meaning that they're going to pay their federal taxes. Then I just have them living in the same exact state and county that I live in, Pennsylvania and Allegheny County, just for simplicity here. So that's their overall picture, relatively straightforward. So what we want to do here is we want to see a couple of things. One, let's look at it from a high level overview. If they do absolutely nothing today, what's their outcome likely to be? Joe and Sally have done a very good job saving. I think that's apparent to everybody here on the video today. But where will they be at age 90? So we see a general retirement spend down curve here, very linearly going down over time. And by the time they reach age 90, they would have about $1.2 million left over. So obviously they would still have money to live should they live longer than that. But the question we want to ask ourselves now, is this optimal? Does a Roth conversion add value here? So the first thing we want to do is we want to look at it if we were to convert at the 12% tax bracket. So you'll see a couple of things happening here. One, we know we're better off by about $1.5 million. And in fact, that's what that green bar is representing here at the very end. By age 90, if they convert their IRAs to Roth dollars early in retirement, we know that they're going to have an extra $1.5 million added by age 90. That's a function of two things. One, the tax savings that they're doing because they're not waiting to pay more taxes that they're required in the distribution stage. And then they're also growing at a better rate of return through the Roth than they would be in the traditional, because it's going from an asset that we're spending down to an asset that we're going to allow to grow for a longer period of time. So a couple of things happen here. This is year one, and we'll see we actually are worse off at the very beginning of the plan because we're front loading those taxes. In fact, the break-even point for Joe and Sally here is until age 72. That's when we cross over from having net worth here being negative because of that paying the taxes up front to being positive. So that's their break-even point, meaning that if they want to convert to the 12% tax bracket, I think it makes sense to do so as long as they plan to live past the age of 72. Now, I know that's hard to forecast, but you can tell based off of family history, current health, and a bunch of other factors, whether they think that's something they can do or not. I would say for a couple with $2 million, age 62 now, if they're relatively healthy, there's a good chance they're going to hit this number. So what we want to compare this to next is at different tax brackets as well. So let's look at it at the 22% tax bracket and the 24% tax bracket. Does it make sense to convert at a higher income tax bracket in order to get more money into the Roth sooner? So let's look at the 22% bracket. And we find that's the case here. They have about $2.1 million of value added here through this scenario, we're seeing a bigger decrease in net worth at the beginning because we're front loading more taxes at the beginning. Their break even point jumps up by a year. So meaning if they live to age 71 in this instance, I would have them breaking even based off of how their assets are allocated and the front loading of the taxes. This is the age they would need to live to in order to be a winner here. And then by the very tail end of the plan at age 90, whether they're still alive or they're gone at this point, they would have about $3.25 million in the account. So it would make sense to convert a little bit higher than at the 12% tax bracket. Now, I know just from doing this for a decade plus that people with $1 million in qualified assets and Social Security benefits of around 50 grand between the two people in the couple. The flipping point here is going to be based off of a couple of things, what their spend pattern is, and then two, whether it makes sense to convert it to 24% tax bracket. So for some people, if they're spending a little bit more money, it's going to make less sense to convert to the 24% tax bracket because they're going to need more money sooner. But if they're spending within their means, it's going to make sense to convert a little bit more. I think for Joe and Sally here, that's what we're going to find, but let's click to find out. And in fact, that is what we found. So we're seeing the same general pattern here where we're spending down and we're losers in a sense earlier in retirement because we're paying more in taxes up front. That break even point happens another year sooner. So instead of 71, it's 70 here in the 24% tax bracket. So if they convert to the 24% tax bracket and they both make it to age 70, they're going to be okay in terms of that break even point. And if they live to age 90, we know that they're going to add about $2.3 million of gains here based off of the base facts. So when we compare that to the 22% bracket, I think it was 2.1. Yep, we would want to move to the 24% tax bracket. I'm going to go out on a limb and just say, and I'm not going to show this to you guys for sake of time here, if they were to go to the 32% tax bracket, they would be a loser in that situation compared to this scenario. They're probably better off than they would be in the baseline scenario and maybe even the 22% bracket, but they would be a loser here compared to the 24% tax bracket. But what I want to show you what's going on behind the scenes is the way that asset allocation is changing, asset location rather, I should say, is changing over time. So if we look at the base facts here, and we want to specifically look at the retirement assets because that's what we're optimizing for right now, is Sally's IRA, if she makes no changes today, will be completely gone by age 85 or in 2048. They would have spent all of that money and then they would just be living off their taxable brokerage account, which by that point should have about $1.2 million in it because we know they're going to be worth about $1.2 million by the time they reach age 90. So if they make no changes, they have no more retirement assets to live off of, just those non-qualified assets. Now, if we were to look at the 12% bracket, where that changes is we're going to see a new account introduced. And this is going to be the Roth account. So we'll see Sally's IRA is the light blue bar here. Now, this dark blue bar in this scenario is the Roth conversion account. So we see that if she does 12% conversions, we'll see that Roth conversion account grow over time. By the time she hits age 70, her traditional IRA is completely gone, meaning that we've converted all the money to Roth dollars, and now this money can grow. So at this point, they're still just living off of their taxable brokerage account, but they're allowing the more tax-efficient asset, which is the Roth IRA, to continue to grow here. By age 90, we expect that to be worth about $2.6 million. So what we're seeing here is they're probably dipping into this from a spend standpoint because I would anticipate that the taxable brokerage account probably is getting close to being liquidated at this point. But what we're seeing here is that they have no traditional assets, probably a small portion of taxable brokerage assets, and about $2.7 million in Roth accounts at this point in time. So if we were to convert it to 22% tax bracket, what I think is going to happen here is we're going to see that Roth IRA is going to get bigger quicker. We're going to see a bigger spend down in the traditional IRA, and we're going to have a better projected outcome at the tail end, which is exactly what we're seeing here in the front end. So we see after 3-4 years, the traditional IRA is completely gone. In fact, it's by the time Sally's 66 and Joe is 66 as well in this instance, the IRA is completely gone. It's all Roth dollars. These Roth dollars continue to grow, and lo and behold, they're worth a little bit more, about $3.3 million by the time they reach age 90. I think we're going to see the same exact pattern for the 24% bracket. It's probably going to be a 2-year spend down. That's exactly what we see. The 2-year spend down of the IRA, all under Roth dollars. This gives us more time to grow at the higher balances early. And yep, better expected outcome, $3.4 million in Roth dollars by the tail end of the plan here. So you'll see what we're doing is we're just changing the overall composition of the assets. We're front loading taxes in order to get to the more tax efficient vehicle more quickly. So that way they could reap the rewards of not having to take taxable distributions from their qualified accounts when Social Security starts, because this will keep their provision, and this will also keep their provisional income low, which will help their Social Security benefits remain non-taxed. Now that we know that we're converting to the 24% tax bracket, the next step is now optimizing in a given year. And I'm going to do that for this tax year. So I know that Joe and Sally are going to fill up the 24% tax bracket. So I want to show you how I would structure that distribution for the year. For married couples filing jointly, the 24% tax bracket goes up to $394,600, which means they can convert $424,600 when you add their standard deduction to that to stay inside of that 24% tax bracket. That total tax on that distribution would be $80,398, which, if you remember, we only held to the side $40,000 when we harvested capital gains in the taxable account. And I made that mistake on purpose because I wanted to show you why you should always go through the overall strategy at the beginning of the year before you start moving money. Luckily for us, I know that we still had capital on hand of about $120,000 after we harvested the gains and the losses and reinvested into the bond position. So instead of holding $40,000, we'll hold $80,000 to the side for tax purposes, and we'll reinvest that remaining $40,000. And we're going to continue to follow that same exact strategy every year until that traditional IRA is depleted. We're going to max out the 24% tax bracket. We're going to hold enough to the side for taxes, and we're going to do that until that sucker is completely gone. So the last thing we know now in this instance is that the traditional IRA will be completely depleted within 2 years of following the strategy. I believe that it would still make sense for Joe and Sally to continue delaying their Social Security until at least full retirement age for the following reason. Next, we're going to use the capital gains brackets to our advantage. In 2025, you can realize $96,700 worth of capital gains completely tax-free. When you add $30,000 standard deduction to that number, that's $126,700 worth of capital gains you can realize during the year completely tax-free. So I would then attack that taxable account the next few years until they reach full retirement age and realize gains up to that threshold to provide current income and pave the way for future distributions to be completely tax-free. The more capital gains that I can get rid of at this point, the less I have to worry about that pushing up my provisional income once I start collecting my benefits, which can in turn help me avoid paying taxes on my Social Security or having that Social Security included in my taxable income. Then I would start to collect Social Security and optimize around the provisional income number only and follow that each year to minimize the taxability of my benefits. And that, my friends, is how you structure a nearly tax-free retirement with a $2 million portfolio. So to wrap this up, the Social Security tax trap is a really sneaky son of a gun. It doesn't show up on a standard tax return or a brokerage statement. It hits when you least expect it and often punishes those who save diligently in tax-deferred accounts. But with smart planning, you can dramatically reduce its impact. To recap, understand your provisional income, time your Roth conversions early, consider delaying Social Security for maximum control, use qualified charitable distributions to meet required minimum distributions without raising your income, layer income from Roth, taxable, and IRA sources for optimal tax efficiency. These are the strategies that we use every day for our clients here at NAV Wealth, and it helps them to avoid surprises with the IRS. If you found this helpful, be sure to subscribe for more retirement strategies that go beyond just investment advice and into real financial planning, which is where the difference is made. Thank you so much for watching, and I'll see you in the next video.